Realtor with Keller Williams and the Grimaldo Group. Chris Verdin.
Good morning, good afternoon, whatever time zone you're in. Yes, Chris Verdin, preferred lender for our Grimaldo Group here at Keller Williams.
So this week, I would definitely want you to focus and listen to this whole message here, because we're talking down payment assistance, we're talking
free money,
we're talking financing programs, money for your purchase. One of the details that I do want you to get around here is the reason I bring Chris around is because he's a professional, and he makes sure that my clients are able to purchase these dream homes that they're getting into, and they're able to accomplish these big audacious goals, right? And sometimes when you have that in your mind, when you have that goal of purchasing a home, there's a lot of variables, and there's many of those variables that with previous preparation you can eliminate and not worry about, and then it just boils down to the money. It just boils down to how much money you can save up, a certain specific number, and a time frame of when you can make that money happen. So if you approach us at the right time, you will have made the best decision of your life, because you won't be scrambling at the last minute when hopefully none of you guys, but it's going to happen to somebody. The renter tells you, hey, the landlord says, I'm selling my house. You need to get out. The landlord says, you know what? Market rate for my rent is actually double. You know, you're paying $900, but I got to get you up to speed, and it's going to be $1,800 now. Just lots of unfortunate events that happen to people who don't prepare. And that's what my whole mission is, that everybody that follows us, follows the Grimaldo Group, has knowledge of where they need to be, by what time. And I'm going to just let Chris go off and give you guys all this knowledge that you guys don't even understand is about to happen right now. Right, Chris?
Yes, if you guys are at home and you have access to a pen and paper, you're serious about home purchase this year, you'll definitely want to get the opportunity to jot down some milestone notes. And just to complement what you said, it's important to have a plan. The reality is, regardless of the state that you're sitting in watching this video, I'm sure you've seen a pinch or an increase in inflation, whether it be gasoline, cost of housing, even interest rates we're starting to see go up slightly. So I just want to reiterate, guys, everyone deserves a home. That's part of the American dream process, right? And the fact that these down payment assistance programs are out there, it surely is the closest thing to free money. So we'll just kind of get into the mechanics of this. We'll cover a couple different loan programs, but the program that I prefer to use gives you what's called a forgivable second loan. Okay, so to be clear, you still have your first loan. The down payment assistance is, as it sounds, it's the down payment, and you can also choose to have a bigger gap of assistance to cover your closing costs. So every loan has a little bit of a different mechanics in terms of how it works. We'll go in the most popular one, FHA. So their down payment requirement is 3.5%. Okay, that money can come in the form of a gift. It can come from a nonprofit or a state bond like what we use. It can come from your checking savings. If you're relocating for employment and your employer wants to do that, they can. Could be checking, savings, 401k. But again, you need to have some skin in the game to show that you're financially responsible, that you're making a small investment for this home. And with FHA, it's 3.5% down. So the program I like to use is called AZIDA Home Plus. It is a nonprofit created by the Department of Economic Security here in Arizona. At the end of the day, the biggest investor that backs and services these loans is U.S. Bank. So to be clear, the small percentage of bankers that are allowed in the state of Arizona to use and are trained for this program, we don't get to control the terms. The state says, hey, what you see is what you get. If you want the 3% help, we're willing to give you to it, but this is the rate that we're associating today. If you want 4% assistance, we're associating it today. And if you want 5% assistance, so on and so forth, we're associating it today. As far as the rates go, rates, honestly, guys, they do change hour by hour, day by day, depending on how the markets perform. But just to give you a rough scope on where the interest rates are sitting with this program, today is January the 12th, 2022. And in terms of pricing, we are seeing the 3% assistance is at 4.25%. If you want 4% assistance, that is 4.5%. And if you roll with the full ride package of 5% assistance, the rate is 5.25%. So remember, FHA requires that you put 3.5% down. So if you do that 3% package, what your obligation would be is you bring 0.5% to the table, and then also closing costs. Now, closing costs does vary. On average, we're seeing it's about, depending on the loan amount, it's about $5,500 and as much as $7,000 in Arizona. So we'll just take an example. If you were to buy a $300,000 home and you did the 3% package, the 0.5% responsibility to you would be $1,500. And if the closing cost was $6,000, together you're purchasing that home with $7,500. Okay, we'll take that exact same example, but let's do it with the 4% package. If you did that example, your 3.5% is covered, plus you're getting that downward of 0.5%, right? So in that example there, it's let's do 1,500 minus 6,000, right? So in that example, you would actually be able to purchase a home with $4,500 cash to close, okay? We'll do this final example here just because I want to really blow some minds here and show you how obtainable home purchase is. All right, so let's do, let's go ahead and do the 300,000 times the 5%, right? And we're looking at 15,000 in assistance.
That's 5%,
right?
That's them helping you with $15,000.
So let me borrow this really quick, just so I can do my quick calculation.
Give the tools to the professional. Don't let me get in the way. I'm just there to find that home, that specific house that your family or yourself would definitely be happy with. All the needs, all the wants. That's my job. You tell me where, when, and why, and I'll go get it for you. And Chris will give you the how.
All right, guys. So in that example, your cash to close using the full ride package would be approximately $1,500, right? These days, I don't even think you can buy a car with less than probably, $2,000 down. Unless you've got excellent credit and you're doing some sort of 100% financing. But even then, they still want a minimum deposit of generally $500 to $1,000. So apples to apples, home ownership is obtainable. Again, this is with FHA with the requirement of 3.5% down. If you're comfortable having the state bankroll you, there are a few other restrictions, or I should say bylaws, that are tied to this program. One of them being is the state's not in it for people that are investors. So if you're going to participate in Arizona real estate, the guidelines are that you have to live in that home as a primary residence for 36 months, specifically with that loan that was given to you. And of course, you got to make your payments on time. Okay. The other caveat to that is you also have to do an online first-time homebuyer class. I've sat through it myself. Majority of it is videos that you sift through. It takes about an hour. You just put in your information, they email you a certificate when you're done. And there's also a minimum FICO requirement. So with that, they'll let me give you a loan up to 45% of your debt against your income if you're at a 640 FICO score. If you have decent credit above a 680, I can go ahead and give you a little bit of a bigger rip on the loan amount since you're showing stronger financial habits with the 680 score. I can give you a loan that's high as 50% of your debt against your income, okay? Now, the income restrictions is something that you do have to be mindful of. It's set as a household income. So if you and your wife are buying a home and your wife won't qualify, they'll still have some minimum qualifications against you if you live in a community property state. But the nature of it is the state doesn't want to help people that are too well off. As a family, the people in the home have to make less than $112,000, okay? Now, how is that decided? The bank is honestly the true deciding factor. They do a verification of employment. There's a lot of variables. Sometimes you're not at your job for 2 years, so they don't give you your overtime. They don't give you your bonuses. That could be something that helps offset it if you feel like your family's past that marker. But again, the whole thing is reach out to a professional. There's a minimum credit requirement, minimum or maximum income requirement, as well as the expectation of the class, and then ensuring that you're agreeing to live in that house for 36 months. So life happens, guys. Let's just use a live example. I had a client who purchased a home here from Pennsylvania, and they said, Chris, I got the bad news. My mom's terminally ill. I got to sell this house and go home and take care of her. Obviously, it sucks. Nobody wants to be in that position, but the state understands life happens. So it is a loose contract. So we'll use the same example of if you bought a $300,000 home, and just for simple numbers, we'll use the 5% package, and you receive $15,000 in help. So let's go ahead and do 15,000 divided by 36 months, right? Which is 3 years. And every single month, a balance of $416.67 is falling off. Okay. So every single year we can confidently assume with simple math, $5,000 a year falls off that balance that you owe the state. So if you live in the house for 1 year, things hit the fan, you got to move and sell. The state will say, hey, out of the 15,000 that you owe us, you got to pay us back 10. You fulfilled 1/3 of your contract, so we'll remove 1/3 of the balance. And when you go to sell your house, let's just say you made 20 grand, you pay us back 5, you get to net 15. So it's a loose contract in the sense that they do want to stimulate housing. They do want to make sure that you're participating in Arizona economy, but they get it. Things happen. It's just one of those things to, again, stimulate the fact that they want Arizona economy to take place. They don't want investors. They don't want people buying and bailing, right? So that was the FHA example, guys. With the conventional loans, it's the same application. You can ask for 3% help, 4% help, or 5%. Now, I do have to state that the income restriction is slightly less. I know it's a little bit silly because, hey, FHA is giving you $112,000 and some change. On the conventional side, Fannie Mae and Freddie Mac, they actually don't want people making past $64,000. It's $63,000 and some change. So there are kind of different shoes that fit every person's financial equation. Again, that's why you talk to a professional to kind of look at loan matrices, find out what fits best with you. But with Fannie Mae and Freddie Mac, if you have excellent credit and you surely are a first-time home buyer, you could actually purchase with 3% down. If your credit's not so good or you're not a first-time home buyer, those guidelines require that you do 5% down. So depending on what interest rate is palatable, depending on how much cash flow you have, you'll actually design your loan based off what feels comfortable. I have people all the time that have sometimes more cash than what is actually needed, but they're like, hey, it's my first time home buy. I want to get that specialty program. So in that situation, we generally go with the 3% assistance because they're getting, bankrolled some help from the state, but they're also getting the most aggressive rate because the more help that you ask for, the higher the interest rate they're going to hit you with. Okay. So again, with the FHA, it's 3.5%. With conventional, it's 3 to 5, depending on how your credit score is in shape. Now, the last program that we can pop you in with is the VA. For me, that is my strongest suit. We, as a bank, my branch manager is a veteran, and what we do to honor those people with veteran status on VA loans is we waive our lender fees. So right off the top, they're getting in with just paying title notary fees. If you're a disabled veteran, 10% or more disabled, the VA will waive any of their fees. I kid you not, guys, in the VA, something that's pretty wild is they offer you 100% financing. So let's just give you a prime example, $300,000 purchase. The VA is already going to give you 100% financing, but maybe you're strapped on the cash to close, the closing costs. Well, I'm going to waive my fees. There's a 50% chance if you're disabled, because a lot of people go into service, come out banged up. The VA is going to waive their fees. So what's left to the table, guys? Well, I told you normally closing cost is $5,500 to $7,000. If we're waiving our lender fees, it's about a $1,400 value there. We're talking getting you into a home for as little as maybe as $4,000, as high as $6,000, right? Depending on what the size of the home is. So, and if you use the down payment assistance program, the state bond is going to give you 3% help. So let's do the math on that. On a $300,000 purchase, let's just say worst case scenario, your closing cost is $6,000 and the state hooked you up with $9,000. Well, Chris, there's some money left over. What happens to that? $3,000, right? Well, unfortunately, we can't just give you a check at closing, but what we do is apply it as a principal reduction. So instead of you starting day one with a $300,000 loan, it's a $297,000 loan. It's crazy. The state is paying you to actually buy a house, and when all said and done, when all chips fall in that $6,000 cash to close equation, if the state's hooking you up with $3,000, your final net adjustments after all the credits, guys, I kid you not, you would potentially buy a house for $3,000 or less, and that's with them paying the extra surplus to you, right? So these home ownership programs, they're well within reach. A lot of the times you do need help with getting your credit in shape, and that's just life, guys. You got to do what you got to do to pay your bills, survive. And we're rebounding off a year of COVID. We're still, unfortunately, being impacted with Omicron. So I get it. All walks of life. You got to do what you got to do to keep your lights on, keep your kids fed, and keep a home over your head. But again, home ownership is well within reach. Not a lot of people realize these programs are available. You got to check in with your local resources. Some of you might be sitting in another state. But the reality is, I would say 75% of states in the United States do offer some sort of a down payment assistance program. Okay.
Nice. And they deserve it. Those veterans definitely deserve
absolutely
all those perks.
Absolutely.
All those perks.
It's the least we can do to thank you for their service.
Thank you for their service.
Yeah.
Now we're going to move on to the second part of the program here, which is a little bit, we're going to play a little bit of a Mythbusters, right? There's a bunch of misconceptions and myths on, first-time home buyer. Like everybody has this preconceived notions or something. I don't know where they get it from. They don't contact me or they don't contact Chris before they get this idea. But just because you've already purchased a home before,
Right,
doesn't mean that you're not a first-time home buyer, right?
that's absolutely correct. So just to focus on the program that we're on, I believe AZIDA, it's either 5 years or 6 year restriction that you can tap into this money. So let's just say you buy a house using this money and you wait the 5 or 6 year threshold and you said, Chris, I'm ready to do again. Unfortunately, my budget's only $6,000. How do we pull this off, right? Hey, let's go make sure that you met the terms and guidelines. You would be able to access those funds once again. The only real stipulation for first-time home buyer, and this is a Fannie Mae and Freddie Mac thing, if they see that you truly have a history of homeownership, and guys, you can't cut corners with the banks. They see, fraud reports, they see previous title records, they'll know if you had ties to real estate in the past. And the unfortunate part is, even something as simple as, hey, my grandpa added me to the title of this home, even though you didn't buy it, you're not on the mortgage, you may not even live in that property, but your grandpa's kind of getting things lined up in the event he gets sick or the foreseeable future, right? So even something as simple as that will trump your first-time homebuyer opportunity. In that circumstance, you would still have to do the 5%. But FHA guys, whether you're buying one house, two houses, even four houses with them in your history, the minimum requirement is always 3.5% down. So worst case scenario, push comes to shove, we can always pivot to that program should you need to.
Awesome.
Right?
Any myths that you've heard about?
One misconception that people have is that the money that you receive from the down payment assistance folks has to be 100% allocated to the actual down payment. Guys, we've had plenty of times where somebody, like I'll give you an example. Arizona is a very hot marketplace right now. And quite oftentimes we write a purchase contract and say, hey, I'm gonna buy this house for $320,000. And there's all these people bidding. It was listed at $300,000, but we worked our way up to $320,000. And now all of a sudden, we committed to this $320,000 price and the appraisal comes in at $315,000. Well, what happens, guys, right? The house is worth $315,000, but we committed to $320,000. I can only give you a loan up to the dollar marker of the value, which is $315,000 in that example. But sometimes people will say, hey, Chris, it's really worth it to me. I want that house. It's in the perfect school district. My kid doesn't have to switch schools. My job's only 3 miles away. I got to get this house. It's worth it to me to pay the extra $5,000. So a lot of the times, even though our clients have the money for the closing costs as a standard buy, we will pivot and as a strategy, use state bond money to help incentivize and say, hey, listen, we know you have, let's just say as an example, $11,000 for the purchase. The closing cost is $6,000. If the appraisal comes in short, we got to pull another $5,000 out of somewhere. What are we going to do, guys? Well, my family's strapped on cash. We're just rebounding from Christmas. I can't get it there. Well, why don't we look at a down payment assistance option as a plan B? We'll go ahead and use this surplus to offset that extra $5,000. And I kid you not, guys, you're allowed to do that. Again, that money is going to be reallocated, but how we kind of move your money versus the state's money, it's a little bit of a massaging game. So I just want to reiterate, sometimes your lenders, if they are aggressive, your realtors are aggressive, we get creative. And depending on your marketplace, if you're bidding on a house that's very hot, a lot of people are interested, we can make a very aggressive offer for you by using some of the state bond money to offset if there is any shortfalls in the appraised value, right?
Awesome.
So that's something aggressive we do.
Exciting. See, that's it. What else do you want?
Yep.
You got free money. You got a plan. You talk to Chris, you talk to Raul, you know when it's going to happen. Just start saving up your ducats, right?
So one other thing we can talk about too, and we have a client in a similar situation is, hey, Chris, you qualified me with the 640 FICO score, and that program, again, only allows me to give you a loan up to 45% of your debt against your income. I paid off my cards. I found my dream house. My credit should be up to date in like 2 weeks. Can I place the offer? Well, it's honestly, we're redlining this type of financial play, but you do have the ability to lock the loan once your credit score populates the 680 score. So basically in that example, as long as we're all agreeing in the room, hey, we may need to ask for an extension, we may not, let's just make sure we're prepared. you can go ahead and start shopping knowing that it's the pricing is secured once you basically feel it's comfortable, right? So oftentimes, guys, we do have a client who meets with us. We issue the pre-qual. They're hot and heavy. We find the house that's just a little bit more expensive than what they would naturally qualify for at a 640 FICO. But what we'll do is lock in their rate once they hit the 680. Then we can give them that small boost and then close the loan. Boom. So another misconception is, hey, you know, the shoe fits, the pricing is what it is. No. If you're working with an aggressive banker, they will push the limits and lock you in or massage your score to get you there. You can even do aggressive things like a rapid rescore where you contact the credit bureaus, pay an expedited fee to get them there. It is costly. It's, you know, generally over $150 a trade line. But, you know, again, if you're burning through some of the state's cash and it's worth it to you, then so be it, right? That's a decision left for the client, not us.
Awesome.
So one other thing too is a lot of people say, hey, can I buy manufactured homes with these type of products, right? Depending on where you live, guys, Arizona does have some rural areas, and you know, with manufactured homes, believe it or not, sometimes the energy efficiency of these homes is better than traditional built homes. So things like, I guess, restrictions being that they have to be a double wide. With modular or manufactured homes, you can either have a single wide or they're double in size, literally is why they call them a double wide. It has to be fixed to real estate, actual foundation. There's a little bit of a quirkiness to these. Sometimes these homes are connected to a well, which you share with your neighbor, versus being on city utilities. Sometimes you have septic tanks, which is basically where your sewage waste goes underground, versus being connected to, again, city utilities. But all in all, they're good quality homes. There's a lot of people out here that love horses, love having true real estate. You know, you got a full acre, 2 acres. You're not living side to side with a neighbor. These are good loans, and the state will endorse them. They'll back them using down payment assistance. So they are honestly quirky products. This is something we are comfortable with. This is something that we do month after month. So if this is something you guys are interested in, know that you can do it. You know, honestly, the only restriction that you really have is to like new construction. The state, because it's a lot of moving pieces, working with builders, it can get costly if you make a mistake. That's not something that they want to financially back. But townhomes, condos, traditional homes, absolutely, we can get them in the door. Just, again, contact a professional and we'll make sure that the shoe will fit.
One more thing I'd like to add.
Let's hear it.
Save your money, people. Get some money in hand, because right now the market's super hot. So you're going to need a little cushion, to be honest. There is these great programs that are going to take care of a lot of that. You're going to need a little cushion to be able to compete out right now. There's some big players out there in the valley just, you know, dumping huge amounts of cash on these properties. So
yeah, it's just not the general public we're going after, guys. Sometimes we're competing against major investors, like Zillow.com is one of the huge ones, right? So Redfin.com, some of these aggregates, they buy and do house flipping, and sometimes they do good, sometimes they do, you know, horrible. Zillow is somebody who's now offing houses on their books, but you know, bottom line is you can never be too over prepared. And we reiterate it all the time. It's just very important that you talk to a professional and that you have a plan.
Yeah, leave your comments. Exactly. Leave your comments. Give us a call if you have any doubts. Reach out to us with time. There's no commitment. We're not going to charge you anything for these.
The consultation's always free.
Right.
Yes.
We're here to help. We're here for you. You know, there's nothing better than in our day to know that we just locked in somebody else's house and we got financing available for them. And
yep. And these programs, guys, they're associated to the loan limits of that set county. So in Maricopa County, with 112,000 income as a family, if you guys don't have a lot of debts, you surely can qualify for a purchase price of $455,000. Okay. The max loan limit that they'll give you is about $440,000. So after you do your 3.5% down carry, the $455,000 purchase price is associated to that loan of about $439,000. So, you know, last year it was just a really crazy historic year in real estate sales where it almost didn't make sense, where the loan limits were so low that we couldn't get people in traditional 3, you know, for sure 4-bedroom homes we were almost priced out. So I just wanted to make sure that everyone's well aware. If you've been on this fight, you've been on this journey for the last few months, the loan amounts have surely increased, not only in our county of Maricopa County here in Arizona, but across the U.S. The U.S., specifically the Housing Urban Development HUD, has realized, hey guys, the cost of housing has gone up. We got to reflect our loan amounts to also do that. So I believe in the new loan new loan limit now for conventional loans is 520 or 540,000. I apologize. So it's a little bit higher. But again, guys, we as bankers want to make sure you guys are up to date, knowing as the cost of living goes up, so does the amount of money you can borrow. So that way you guys can surely get a quality home.
Let's get you to that next step, guys. Give us a call. Don't forget.
Email, comment, whatever's best. We're here to help.
Have a great one.
Thank you.
Thank you.